Hello, hi. My name is Jerry Miller from Trendsignal, the trader education company. This is another one of our money market insights. And I do feel like I'm sort of repeating myself, but we're going to be looking at UK inflation again. It's funny how it comes around every month because they do release it every month. And also, I'm going to look at US interest rates and the US dollar. These are all issues that are driving our markets. They're certainly driving the UK markets, that's for sure. Been a right old pig's ear with the Truss administration rolling back all these this mini budget and the tax breaks. But as I speak to you on Monday morning, a lot of stuff is still up in the air with regards to what the new Home Secretary, sorry, a Chancellor, I should say, Jeremy Hunt's going to be doing with his statement in the House of Commons on Monday afternoon. But it's got to be something that does satisfy the markets because after Truss had her press conference on previous Friday announcing the sacking of Kwasi Kwarteng and the appointment of Jeremy Hunt, the markets weren't hugely impressed, and neither was I, to be honest. There are quite a few holes still in the tax and spend announced by Kwasi Kwarteng. Anyway, let's have a look at what we're expecting in terms of data out this week. So I'm just going to have a look at the Forex Factory. Okay, so here we've got a calendar from Forex Factory. We use it. It's quite straightforward. It's tells you the detail, what's due out, the forecast or the consensus, as we would call it, what it was previously, and that's all you need to know, really. So on Wednesday, at actually the time on this is wrong. I just want to change the time back to that, so we have the right time. Um, okay, there we go. So that comes out at 7 a.m. Apologies about that. 7 o'clock on Wednesday morning. They used to release these sort of midday, but everything since the pandemic, everything has changed. So it's all the data is all known when the markets open. We're expecting a slight uptick in inflation, and that's up to 10%. That's the first time it's been in double figures. Um, Not much of a move, actually. We've had a slight uptick in oil prices over the last couple of weeks, but they did actually pull back last week. But there's another number that you should also be aware of that's not actually showing on this particular calendar, but that's the what we call the core inflation, and that excludes the components that have actually been driving energy. The inflation high, which is energy costs. That's the likes of gas and oil. Um, and it's the core price that a lot of central banks are looking at more closely these days because that's the baked in hard to shift inflation. And once that gets embedded in the system, that's what really worries central bankers. So the Bank of England will be looking very closely at the core reading at 6.4%. Needless to say, sterling, equities, gilts, those are the sovereign bonds here in the UK, all very sensitive to this release at 7 o'clock on Wednesday. Okay. Okay, let's having looked at inflation, let's have a look at US interest rates. And it was quite an interesting move last week. I mean, we we were looking at inflation released on Thursday. That was the big number that we're expecting. Everything's to do with inflation these days. It used to do with interest rates, quantitative easing, and the like. But now it's very much focused on inflation and anything that affects inflation. Anything that tells us what inflation will be in the future is even more interesting. So last week we had the US read of inflation, and whilst it was pretty strong, curiously enough, the market actually fell. Let's just have a quick look at that now. So this is a chart of the S&P 500. And the candle I'm hovering over, this green candle here on the 13th of October, was the day of the inflation data. Now, the inflation data came in quite a bit stronger than expected. Let's have a quick look and I'll quickly show you last week. So last week, the CPI data came in at 8.2 instead of 8.1. But more worryingly was that the core rate came in at plus 0.6% rather than plus 0.4%. So that is a big worry to the central bank. Initially, the market sold off on Thursday last week, but actually by the close, it had rallied 2% or more. And the reasons are sort of twofold. Firstly, we'd had a sell-off in the markets for 6 days. So a lot of traders were short. going into the number. And we also had a few analysts had been talking about it more recently that the inflation reading is not really telling us what's happening about the future. So it's sort of a backward-looking indicator in a way. For example, producer price index, which tells us what the cost of goods and services are going into production, that's like a leading indicator for inflation. So that's something the market can look at. But actually, so the market just got squeezed higher, a good old-fashioned market squeeze. On Friday, what we actually had was a release from the University of Michigan Consumer Sentiment, which also gave us a clue as to what inflation uh, was doing, sorry, what inflation expectations were, I should say. And the inflationary expectations was the thing that actually was worse than expected. And you might sort of wonder, well, that's consumers telling us what they think inflation is going to be. How's that going to affect the markets? Well, if they're thinking and expecting prices to rise, they're more prepared to pay higher prices. So it tends to lead to a higher inflation rate. It becomes what I describe as self-fulfilling. Um, anyway, that caused the market on Friday to turn tail, and in the end, equity markets, I think on the week, Nasdaq was down about 3.1%, the S&P down about 1.5%. So they really did take fright. And one of the reasons why is you only have to look at this, which is this Fed Watch tool from the Chicago Mercantile Exchange that plots the um, Fed funds rate and puts in this rather handy little calendar that tells us what the likely rates are going to be on the days of the rate setting committees policy meetings, and there's next one's on the 2nd of November, and you'll see just looking at this chart that there appears to be a 99% probability of a 75 basis point or 3/4% rate rise. So that's really pretty much a shoo-in. And that has changed, that's hardened quite a lot over the last week. A week ago, it was 76.5%. It's now 99.8%. And actually, if you look at the last meeting of the year on the 14th of December, um, there's a 66% probability of another 3/4% rate rise, taking the rate up to 4.5%. And if you look down here, a week ago, that was just 29% probability. So that is what I mean by expectations hardening. And that's what's really dominating the market thoughts. And so most analysts, most traders, investors are really trying to look out for numbers that are telling them what inflation is going to be and how that'll affect the way the Fed are thinking in terms of how they're projecting future rate rises. Okay, let's just have one more point. Okay, my final point and my final topic really is the US dollar. Not surprisingly, interest rates and currencies are closely linked. For example, with a higher interest rate in the US, you're going to see the US dollar rally. And it did rally last week. Just got my notes here. Not too much against the euro. Sterling was a bit of an outlier. I'm not going to go into sterling much more than I have done over the last few weeks, but it recovered on the back of the sacking of Kwasi Kwarteng. But the one that really stuck out was the dollar yen. I'm going to quickly look at that chart. So here's a chart of the US dollar versus the Japanese yen, and this is the the Japanese yen falling. But remember, this is the number of yen to the dollar. So as the number of yen increases, that's the yen weakening and the dollar strengthening. And I've been trading and following the markets for 40 odd years now. And I have seen moves like this before, but it is extraordinary. The Bank of Japan and the Japanese administration are allowing this to just happen. And they're constantly worried about the impact on inflation. But for some reason, they're not changing their easy monetary policy at all. We were back at 114, 115 at the start of the year. So to fall into 148, it's a huge fall, and it has massive inflationary implications for Japan as they import all that energy, all the gas and oil that's all priced in dollars. It's an expensive old business. And obviously other things that are hitting other markets. Let's just get the detail back. Gold is something that has been under a lot of pressure. I mean, it's rebounding as I speak to you on Monday, but it had a pretty torrid week last week, falling about 3%, $52 on the week. And it's not surprising when you look at the strength of the dollar. Gold's a dollar-based commodity. And when you then look at the cost of holding gold, gold doesn't pay you a dividend. Gold doesn't pay you a coupon. It doesn't earn any interest. If anything, it costs you. You have to work out what the opportunity cost would be. So as interest rates go up, the cost of holding gold goes up. Not only that, you've got to insure it, you've got to warehouse it. It's an expensive business, and I think, despite the fact that it's recovering as we speak, the lows from the end of September, very multi-month lows. I mean, you've got to go back a few years, sorry, several months, I should say, right, right back to sort of middle of 2020. So not looking good, I'm afraid, and that's one of the consequences of dollar strength with dollar-based commodities, and it'll be affecting the oil markets as well, although that's partly down to OPEC's attempt to get more income for themselves. Anyway, I won't get started on that. I'm not a big fan of OPEC either. Anyway, thanks very much for listening. All the best. Bye for now.